stock market crash 2023. So the question is, how long is this bear market going to last? So I'm going to share with you an article here. Actually, it's already up, as you can see it. And I've got two articles I want to share with you today. So let me give credit where credit is due. So first of all, this is Statista. And also I want to just go down and give, let's see, the credits are down here. There we go, sources. So you can see that. All right. Anyway, this is what I really wanted to show was this chart right here, this graph. So here's where we are right now. So we don't really know, of course, what's going to happen, but I do want to point out that right now we're a little bit more than this, about 22% down from the highs, and that's pretty accurate. Now, my last video I did, if you want to see the example of this, the demonstration of this, the documentation of it, my previous video is Fibonacci retracement indicator, and I show this actually on the chart. Okay, so that's there if you want to see the example of it, but that's still about where we are. So first of all, first thing we want to see is, okay, so how deep can we go, bear markets? And you can see that really we're not that deep yet. And I made that point on my other video too, just for my own technical analysis. So yeah, 22% compared to other bear markets, not that bad. Right, we're actually in the shallow range of bear markets. So the big question, of course, people have is how far are we going to go down from here? And past performance is not indicative of future results, but at this juncture, we could say compared to the previous bear markets, it could be worse. It could be a lot worse. Okay, so anyway, don't think that this is something out of the norm. That's really my point with this particular, there's a couple of points with this particular image. Number one, being down 22% or so, we're a little bit below that last time I looked. Not really that terrible when you compare it with history. So let's get that straight right now. Okay, so a lot of people are freaking out. Historically, it's not unusual at all, In fact, it's not bad compared to other bear markets, and we are in a bear market. All right, and bear market is officially defined as 20% down. Okay, so now let's look at recovery months. This is the other thing that I wanted to look at. So there's two columns here. You can see one is the length. Actually, let me bring up my drawing tools so we can see this. So the first one there you can see is the length of the bear market. So that's the other thing we want to know is, well, how long are we going to stay in this bear market? So what have we seen in the past? Well, right now, we've been in for about a year. Okay, started about a year ago. And so that'd be 12 months. And we could see that, again, that's not too bad. Now, there's a couple here that only lasted 3 months. So those were really short. But others, well, 1 month, that's COVID, by the way. That was the shortest bear market that I'm aware of. 17, 20, 21, 31. Okay. But that's what a lot of people will show you on graphs. But I like this graph because I love the fact that they also put in this other column right here. And this, to me, is really important. And that is, as you can see, their length of recovery. So length of the market, that just means how far or how long did it take to go down until we started going back up. But length of recovery means, well, if you dollar cost average, by the way, 2 videos ago, I did a video on dollar cost averaging, if you want to check that out as well. These are all related. I'm doing a series here, a theme, all around the bear market. So if you look at that and you're investing all the time and all the way down, then you could say, oh, okay, well, the bear market might say, just looking at this column, oh, okay, bear market didn't last too long. But wait, how long did it take to recover my money to get back to where we started from at the top before we started going down? Oh, okay, wow, 69 months. That's a long time. All right, here, again, a little short of 2 years. These two, long time, 4 years. Right? Over 4 years. So, you know, closing in on bad news here. And these were very deep moves. Now, that looks bad, but it gets worse. Okay, not to leave you with good news here. Okay, let's take another look at another chart. All right, so let's go to a second article. And again, to give credit where credit is due, this is an article from amgfunds.com. And you can see the author here, Michael E. Schroer. Hopefully I've got that name correct. Excellent article, by the way, called The Lost Decade Revisited. So this gives a little different perspective on the last chart that we just looked at. So what's happening here in the lost decade for stocks is it's a well-known term, and it refers to, as you can see there, those dates right there, end of 99 to end of 2009. And it's when the S&P 500, the benchmark, generated an annual total return that was negative for 10 years, a decade. And if you want to see the detail, well, it's down there already. You can see it. So, in fact, let's go down here a little bit, because I want to show you there's the dates. And so the blue line is the S&P 500. And then he's got three other different markets down there as well, mid cap, small cap, etc. Okay, but if you're just investing in the S&P 500, which is a benchmark by which most fund managers are measured, you can see 10 years. Now, why is this important? So first of all, look at the dates. So in contrast to the previous chart that we looked at, this incorporates two of those bear markets. It incorporates the tech bubble and it incorporates the global financial crisis. And so when you combine these two together but accumulate the two of them together, 10 years of nothing. Nothing. And why is this important? It's because a lot of people will tell you, oh, the stock market just goes up over time, so just invest and you're going to be good over the long term. Well, that's true over the last 150 years. It's done that. Again, past performance is not indicative of future results, but that is what happened historically. The other thing, though, is where are you in your life? So let's say you're 7 years away from retirement. Okay, and right now we're in a bear market. We're down over 20%. So what if, and again, not predicting, not saying, but we have had a bear market, a couple of bear markets that have lasted for over 10 years, where they returned no positive returns. So is that really what you want to do if you're 7 years away from retirement, or 5 years away from retirement, or even 10 years away from retirement? We don't know what the next one will be, right? What this one will be, I should say, because we're officially in a bear market right now, being down over 20%. That's usually what people refer to as the official metric for a bear market. So, not telling you what to do, don't know what's going to happen, but what I do want to show you is historically, markets have stayed bearish for 10 years or more. It's happened a couple of times. Now, we are in a very unusual situation with the market right now, where it's been pumped up with printing money. It's been held up with low interest rates. So could this be another crisis? I don't know. That's for you to decide. Talk to your financial advisor, so forth, about what is best for you. And the key is at your time in your life, your risk tolerance, how much money you already have. There's so many variables here. It's a very individual decision. That's why you need to talk to a financial professional about your personal situation. There is no one answer for everybody, but it's just important to be realistic. If there's anything, that's my message for you today, is to don't be overly optimistic. Be careful with your money. All right. So, a couple of other things that I will share here. So what are some things that we can do that you might want to ask your financial advisor about? So one is, dollar cost averaging. Again, I've got a video about that if you want to check that out. We'll put a link to that in the description below. But one thing you could do if you decide to do dollar cost averaging is you can, number one, do dividends. Look for dividend stocks so that if the stock price is going down, you're still collecting dividends along the way. So that helps to hedge the price of the stock going down. All right, another one would be look for outperforming markets. That's number 2. So outperforming markets would mean, and I did a video on that as well. Heck, I'll put that link in the in the description as well. So I've got a technique where that I use to attempt to outperform the S&P 500, because they say there's always a raging bull market somewhere, there's always a raging bear market somewhere. So you can look at other assets, could be commodities, could be currencies, could be various sectors or industries that are diverging from the S&P 500 and what it's doing. So that's another potential strategy in bear markets like this. A third one would be, and this one's a little more sophisticated for sure, and that is incorporating options, where perhaps you're doing some cash secured puts, maybe covered calls. These are more advanced strategies. Definitely do not do them unless you really study and become proficient and expert at trading options. But they can be used as good strategies. Options were created to hedge risk. A fourth one would be to not even invest in stocks, but invest in interest-paying instruments, financial instruments, such as, well, corporate bonds, treasury bonds, things like that. Again, do your research. Typically, the higher the percentage payout, the more risky they are. So the closer you get to retirement, generally people like to minimize their risk, might get lower returns, but again, you need that stability. And then if you really want to get into, become a professional trader and learn how to read charts and really try to time the market, I encourage you to get my timing indicator. And for long-term patterns like this, I look for it on the monthly chart and the weekly chart. So as you saw, some of these bear markets last for years and years and years. So we're going to look at the monthly chart for turnarounds on this. And I give away my timing indicator. It's my market entry indicator. And I give it away for free to all of my video viewers, which is you, of course. And yeah, it's free. So go get it. It's at indicatorwebinar.com. It's a common indicator already on your charts, but we modify it. That's one of the keys. And then I show you how to set it up on your charts. And then I show you how to trade it, because that's actually kind of counterintuitive on how to trade it. So that's why I do it on a webinar, but I decided to record the webinar. So it's on a recording, and that allows you to view it anytime you want, whenever it's convenient for you. No charge, my gift to you. Oh, finally, as I said, I'm doing a whole series right now. This is the 4th in the series on how to deal with bear markets. So if you want to tap into the series, get future videos, subscribe. Go ahead and click the subscribe button to the channel, and that will give you announcements whenever new videos come out. And right now, gosh, I'm doing about 2 to 3 videos every week. So subscribe and enjoy the goodness.